Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Friday, January 16th, 2026.
That's right. And we're looking at all the data collected yesterday, January 15th, 2026.
Well, our AI sifted through quite a bit of discussion this past 24 hours. We saw a really high volume of activity, actually over 1,000 mentions across 27 different stocks.
And the overall sentiment? Pretty mixed, Ethan. We've got some very promising tech and AI stories, but also a good dose of caution for some of those more speculative plays.
All right, let's dive right into it. First up, we're taking a look at Rocket Lab Corporation, RKLB. Now, the social media buzz was certainly high, with some users talking about aggressive, leveraged plays, banking on strong momentum. They were jacked to the tits, as one user put it, with short-term gains in mind.
Jack to the tits sounds like a red flag to me, Ethan. When we look at the KPIs, RKLB's profitability is still negative across the board. EPS, net profit, operating margin, plus the price-to-book ratio is a very high 35, suggesting it's way overvalued relative to assets. And let's not forget the significant insider selling, over 72% net shares sold. That's a huge sign of caution from those closest to the company.
It's true. The comments largely echoed your sentiment about the high-risk strategy, warning of potential losses. RKLB's rating has been quite volatile in the past, swinging from a buy in late December to stay away or speculative gamble more recently. Today, despite some of that user optimism, those financial concerns loom large.
Absolutely. Our AI insight suggests that given the persistent unprofitability, high valuation, and insider selling, we really can't justify the risk here.
So for RKLB today, our AI-generated insight is to stay away.
Next up is Galaxy Digital, GLXY. Now, we saw some very bullish news about them doubling their data center power capacity, which is a massive infrastructure expansion. That's a good sign for future revenue potential. This stock was last rated a speculative gamble back in October.
That's right, and market reactions to similar news have been positive for GLXY. This expansion could really position them for growth in crypto mining or other high compute demands, and it could certainly improve future revenue and potentially their EPS down the line.
It could, Ethan, but let's look at the current picture. Their PE is still a very high 57, suggesting huge growth is already priced in, and the net profit margin is razor thin, only 0.00379. With a debt-to-equity ratio of 142 and insider selling, that growth story needs to deliver significantly on profitability and quickly to justify the current valuation and financial leverage. Given the mixed signals where the news points to future potential but current financials are quite stretched, I'd agree. For GLXY, even with the promising news, we're classifying it as stay away for now with a close watch on those profitability numbers. Moving on to Planet Labs, PBC, PL. Social media chatter had it grouped with other risk-on names, perceived as a moon or crash type of stock. It's been on a monster rally, almost 10x from its 52-week low. And that rally is precisely why we need to be cautious. It's trading near its 52-week high, with a beta of nearly 2, confirming extreme volatility. But fundamentally, Ethan, it's unprofitable, with negative net profit margin and EPS, plus a staggering 131 debt-to-equity ratio, and insiders have been net sellers. The valuation is very high at 25 PB for a company that isn't making money. Some analysts have given it outperform ratings and raised price targets, citing growth potential in AI tailwinds. It does show potential, but it's never been rated by us before. Potential, yes, but the current financial reality is too weak for a solid investment. The insider selling and high debt especially concern me. So for Planet Labs today, our AI-generated insight is to stay away. All right, let's talk about Taiwan Semiconductor Manufacturing Company, TSMC. This one sparked some seriously bullish sentiment. Users were hyped about their target of up to $56 billion in 2026 capital expenditure and around 30% revenue growth, all driven by the AI boom. It's a key supplier, Brooke, you know that. We had it as a buy last October. While, Ethan, the numbers do back up a lot of that enthusiasm. And the numbers certainly support the AI-driven narrative, Ethan. Revenue growth is a robust 35.6%, which is fantastic. While the PE ratio is quite high at 119, that often reflects aggressive pricing for future growth in a hot sector like AI. What's particularly compelling is the significant insider buying, over 4% net shares purchased in the last 6 months. That's a strong vote of confidence from within.
Yeah, analysts are on board too, calling it a top 2026 pick and an IBD stock of the day. User sentiment was dismissing any AI bubble talk, just pure enthusiasm.
Right. Despite the high valuation, the strong growth, positive analyst sentiment, and especially that insider buying, suggests AMD is well positioned for continued upside in this AI revolution.
So, maintaining our conviction, for AMD today, our AI-generated insight is a solid buy. Let's talk about ASML Holding, ASML. This one also saw massive bullish sentiment, hand in hand with TSMC's positive outlook. Users were celebrating ASML's market value exceeding $500 billion, calling them indispensable in advanced chip manufacturing, especially with EUV lithography. This is a first-time mention for us, Brooke.
Well, it's certainly a powerhouse, Ethan. While their historical revenue growth of 0.7% looks low, it's clearly a lagging indicator given the forward-looking discussions about AI and TSMC's huge capital expenditure. What truly stands out are their exceptional profitability metrics, a net profit margin of nearly 30% and an ROE of over 53%. That indicates incredible efficiency and financial strength.
And that indispensability factor is huge, right? They're practically a monopoly on the advanced equipment needed for these cutting-edge AI chips.
Absolutely. Their unique market position and outstanding profitability, combined with the anticipated future growth from the AI boom, make a compelling case despite the high PE and PB ratios.
So for ASML today, our AI-generated insight is a buy. Now for Alphabet, Google. A user was explicitly bullish, stating, if Tesla is going to moon, Google is going to moon harder. That kind of confidence, it gets attention. We've largely had it as a buy recently.
It does get attention, and it's backed by some solid numbers. A robust 32% net profit margin and 15.9% revenue growth are excellent for a company of Google's scale. Their 35% return on equity is also a strong indicator of efficient capital use. The news about the potential Apple-Gemini partnership is a huge positive catalyst for future AI revenue.
Exactly. And that insider buying, over 1.9 million net shares purchased, signals strong internal conviction.
While the PE of 32 is a bit high and the debt-to-equity ratio is elevated, the overall fundamental strength and the significant AI catalysts certainly make a compelling argument for continued growth.
So for Google today, our AI-generated insight is a buy.
Let's turn our attention to Apple, AAPL. While there wasn't much direct discussion about Apple's future performance, the overall market sentiment in the comments was very cautious about highly leveraged, aggressive plays. It last came up as a buy for us recently.
Apple still has some exciting catalysts on the horizon, like AI-powered Siri, potentially with Google Gemini, and even a foldable iPhone. Analysts are talking about these as potential growth drivers. Plus, we did see a small net purchase by insiders.
They're great catalysts, Ethan, but the current financials warrant caution. A PE of 34 for a mature company like Apple is quite high, suggesting a lot of future growth is already priced in. Their revenue growth is moderate at 7.9%, and the debt-to-equity ratio is high at 152. With the stock trading closer to its 52-week high, there's less immediate upside, especially if those catalysts take time to materialize.
So given that general market caution and the current valuation, those future positives might already be factored in.
Precisely. For AAPL today, our AI-generated insight is to stay away.
Moving to Reddit, RDDT. We saw a quick $44,000 options gain by one user, fueling a bit of excitement about volatility. But then there were also posts questioning why the stock was down, and an experienced trader actually cashed out their position before it collapsed. Our ratings have consistently been stay away or speculative gamble for a while.
The volatility for quick trades is clear, but when we look deeper, the PE ratio is an exorbitant 105. That implies an extraordinary amount of future growth that the current business model isn't necessarily demonstrating. User comments and even analyst reports highlight serious concerns about their advertising platform's effectiveness and ROI. And critically, insiders have been massive net sellers, reducing their holdings by nearly 40%.
Yeah, the social media discussions had direct feedback from advertisers complaining about poor targeting. It's a big red flag for their primary revenue stream.
It certainly is. The high valuation, insider selling, and real questions about their ad revenue make this a very risky proposition right now.
So for RDDT today, our AI-generated insight is to stay away. Let's talk about Poet Technologies, Poet. This one had a strong YOLO vibe, with users buying long-dated call options, really believing in its massive potential for the long term. This is an interesting one, Brooke, because our previous ratings have been mostly stay away or speculative gamble.
Well, Ethan, the data presents a clear dichotomy. On one hand, you have phenomenal revenue growth at almost 80%, which certainly supports the massive potential narrative. And then there's the truly astonishing insider buying. Over 959% net shares purchased by insiders with zero sales. That's a huge vote of confidence from within. That's a massive signal, right? People inside the company clearly see something big coming. It is. But on the other hand, the company is currently unprofitable with negative EPS and carries a very high debt-to-equity ratio of nearly 11. The price to book is also very high. So while the growth and insider confidence are compelling, the current financial screams high risk. So it's definitely a high risk, high reward situation. Given the strong insider buying and high revenue growth against current unprofitability and debt, for Poet today, our AI-generated insight is a speculative gamble. And finally, Immunity Bio, IBRX. The sentiment was sky high for this one, with users cheering IBRX to the moon. There's a strong belief in their cancer treatments, positive news about drug approvals, and talk of a short squeeze. This is a first-time mention on the podcast, Brooke. This is an exciting one, Ethan. While historically they've been unprofitable, typical for a biotech in development, the recent news is a game changer. A massive 700% year-over-year increase in Q4 2025 net product revenue due to their Enkiva drug is incredibly significant. That directly addresses the profitability challenge and paves a clear path forward. Absolutely. Plus, they've had multiple regulatory approvals for Enkiva in the EU and Saudi Arabia for bladder cancer and promising results for lung cancer and others. The short interest is also substantial, adding to that squeeze potential. Exactly. That revenue surge means they're successfully commercializing. And while the EPS is still negative, that 700% growth is a huge step toward turning profitable. It's trading near its 52-week high, indicating market confidence in these developments. So for IBRX today, our AI-generated insight is a cautious buy. All right, that was a busy morning. Let's quickly round up today's top candidates for deeper analysis. Investigate as buy: Taiwan Semiconductor Manufacturing Company Limited, TSM, Advanced Micro Devices, AMD, ASML Holding, ASML, Alphabet Inc., Google. Investigate as cautious buy: Immunity Bio, IBRX. Investigate as speculative gamble: Poet Technologies, Inc.
And that wraps up another episode of the Daily Hunt from Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We'll be back next time with more AI-generated insights for your daily hunt. Have a great rest of your Friday.